Good afternoon, everyone, and welcome to the December 2024 edition of Epic Insight. This is Joe Corona, and I am the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I will be your host for today's call. Before we get started with today's session, we want to thank all of you for taking the time out of your busy schedules to join us today and throughout 2024 for our Epic Insight webinars. As we wind down 2024 and look forward to 2025, we thought it would be a good time to focus on the policies and trends that are driving our economy these days and to look forward to what the new year brings. With that in mind, we're excited to have joining with us a familiar voice to many of you who have attended our Elevate conferences in the past, Ken Entenmann of NBT Bank. Ken is a Senior Vice President, Chief Investment Officer, and Chief Economist of NBT Bank, and has over 30 years of investment management experience. A graduate of Cornell, Ken earned his MBA from the University of Rochester Simon School and is also a chartered financial analyst. Your line will be muted throughout the call, but if you have any questions, please enter them in the webinar control panel, and we will address them at the end of the session. With that, I will turn it over to Ken.
Well, thank you, Joe, and good evening, everybody. It's been a remarkable year, and things, I think when you look back on this year and go back a year ago to the beginning of 2024 with expectations for a recession, significant rate cuts, higher unemployment, none of that happened. It's really been a year of great resiliency. When we look at GDP, it's really been quite remarkable. When I look at the last 4 quarters, GDP has averaged 2.65%, which is pretty remarkable. When you look at the box in the bottom right, the 24 estimate is for 2.6% growth. When I started this chart in the beginning of the year, it was for 1.5% growth with lots of expectations for a recession. And the momentum continues. The Federal Reserve Bank of Atlanta has it's an app that you can download. It's called Economy Now, and they provide kind of day-to-day. They update a GDP forecast, and quite frankly, everybody hated it at first because it overestimated GDP growth, but they've been pretty accurate over the last several quarters. In fact, the last 5 quarters of GDP growth have comfortably exceeded the expectations of the market forecasts. Yet when you look at 2025, if I go to FactSet and look at the consensus estimates, it's for a slowing economy of 1.8, but with the GDP in the 4th quarter looking to come in excess of 3%, we have a pretty solid economy. But I would caution you that the economy is, these numbers here kind of mask a little bit more of a divide on the economic front. It really is more of a have and have not economy. So clearly there have been pockets of recession or really weak economic environment. I don't think anybody needs me to say that the housing market has been in a funk. Existing home sales you see here on your top left have really plunged. Part of the reason is the bottom left, housing prices in the NBT footprint, our bank's footprint, which is basically the northeastern segment north of New York City without Boston and New York. That's kind of our footprint. Over the last 3 years, the average house price in our mortgage portfolio is up 40%. When you combine that with the 30-year fixed mortgage rate that's somewhere in the neighborhood of 6.5%, quite a ways from the 2 handles on mortgages that people were getting a year and a half ago, really has put a hurting on housing, and then most importantly, a severe shortage of about 4 million single-family homes continues to exist. So the housing market has been a clear weak spot, as has the manufacturing sector. When you look at this chart on your top left, the ISM Manufacturing Index, this is an oscillator index. So if it's above 50, you have expansion. If it's below 50, you have contraction. And what this chart clearly shows you is manufacturing has really been below 50 for a considerable period of time. Hasn't really recovered from the COVID slowdown, and it's still struggling. So real weakness there, but it's certainly more than made up for on the service sector, which is the non-manufacturing index. You can see that picking up. I do want to call your attention to the Small Business Confidence Index. One of the small businesses really struggled in this economy, even though the headline numbers are terrific. Small business are still struggling with higher costs, higher financing costs, labor shortages. Inflation in general hits small business harder. What I would say, we're just getting the data before November, but the post-election bounce in confidence and optimism in small business is pretty material, and we'll talk about the impact of the election in a few minutes. But the story is housing, manufacturing struggling, the service sector really doing well. So kind of a have and have not market. Why is that? Well, the U.S. economy is basically 2/3 of the economy, 60 something, almost 70% of economic activity is driven by consumers, and the U.S. consumer has been a superhero. We have talked, there's lots of fear mongering in the marketplace that the consumer is about to become Thelma and Louise and drive off the cliff and force the economy into a collapse. We don't believe that's the case for a couple of reasons. First, the employment market has remained remarkably resilient as well. You can see the unemployment rate in the blue here. So in November of 24, we're currently at 4.2%. Lots of discussion from the Fed and others about a quote unquote softening economic or labor market. And indeed, the unemployment rate's gone from 3.5 to 4.1. But I would caution you, 4.1 is still historically very, very low. And importantly, a big part of that increase from 3.5 to 4.1 is being driven by an increase in the labor participation rate, which means there's more workers available, which in the long run I think is actually a good thing. But the fact that the labor market has remained so resilient has kept the consumer in really good shape. And I think when you look, and this gets back again to the have and have not of this strong economy, for the average consumer, they're in really good shape from a consumer balance sheet standpoint. So this kind of breaks down the major subcategories on the typical American's balance sheet. And if you look at the asset side, there are two clearly dominant positions. One is homes, and the other is when you talk about pension funds and other financial assets, 401k plans, et cetera. Really the world we live in, they are by far and away the dominant assets. And for the majority of Americans, I just said, across the United States, home prices over 3 years are up 40-something%, which tells you home equity is increased for folks. And obviously, we're in the midst of a second year bull market where it will be the 2 years of 20% plus growth in the equity as measured by the S&P 500. So the asset side of the consumer balance sheet has increased quite a bit. And then when you look at the liability side, and you hear all kinds of talk about student loans and auto loans and credit card debt increasing, and they're all increasing off of really historically low levels. So people will cite that as a concern, but I would look at this liability and say it's the mortgage that matters. And unless you've been sleeping under a rock in the last couple of years, you refinance your mortgage. I mentioned earlier, mortgages around 6.5%, give or take, today. I know people who refinance their mortgage at 2.5%, resulting in enormous savings. And so when you look at that refinancing of mortgages, the paying down of debt that came out of COVID, we have a household net worth of, which is now almost pushing $155 trillion. So that economic strength is pretty important. And the consumer. We got retail sales this morning, which there's some vagaries to it, but still showing a pretty strong consumer that's willing to spend, particularly on experiences, travel, things like that. So I've flown 2 times in the last month, and every plane has been sold out, and the airports are pretty crowded. So the good news is, for the majority of Americans, their financial well-being is pretty strong, and that's driving the consumer. But I would call your attention to the have-nots part of this. So this audience, there's a bunch of us, almost by definition, we are somehow involved with 401k plans, whether we're managing them, administrating them, third-party record keeping them, we're involved there. So the majority of the people that we're facing off with do own homes and do have financial assets. But for the lower income categories, they typically don't own their home, and they don't have a lot of financial assets. And that's where, the worries about credit cards and things like that occur. So there is a bit of a have and have not nature to our economy right now. But overall, pretty strong, a pretty strong economic backdrop. I do think, particularly for those low-income people, inflation, while it has been trending lower, is still somewhat elevated. So this just gives you a bunch of different inflation measures: the consumer price index on your top left, producer price index on your top right, the Fed's favorite number, the PCE deflator, on your left. And it shows that in all 3 of those charts show the big spike in inflation in the post-COVID world. That was largely driven by supply constraints. We all remember all the ships anchored off the California coast with all the goods and all of that. But you could also see the big trend. So the great news is inflation is trending lower. However, when I look at the Fed's favorite measure, which is core PCE, so it's that's the personal consumption expenditure index, year over year, excluding food and energy, that's the core. When I go back to May, I don't know that the trend is lower anymore. That looks like a flatlining trend. And indeed, in the last 2 months, we've had some pretty warm inflation numbers. And in this index, you've seen inflation pick up a little bit. I think that helps explain the angst of the political season, where a very large swath of lower income and middle income people who were really getting beat up by this inflation, voted to make a change. And this chart gives you CPI, again, the consumer price index. When you look at it over a 3-year period, lots of pain, right? The CPI is up 19%, almost 20% increases in prices over the last 3 years is pretty painful. And so the Fed has this really difficult task of trying to control that. And I would caution, we'll talk a little bit about this when we get into interest rates at the end. But I think there's a lot of people hoping that the Fed's going to declare victory, and the market expectations are for a whole series of rate cuts. And I think after last week's inflation data, I think the expectations for rate cuts in 2025 are diminishing as we talk. And as we meet here, the Fed is meeting today, and will have their interest rate announcement tomorrow at 2 o'clock. So we just had a pretty meaningful election, and there's lots of people talking about what that means for the marketplace. I would sum it up in these 3 buckets, if you would: tariffs, taxes, and regulation, kind of like lions, tigers, and bears on my. I would note that the S&P 500 is up 6% since the election. So the market has reacted very favorably to the election results. I think that really revolves around 2 of these buckets here: taxes and regulation. So let's dive into that. On taxes, the this is the area where the two candidates, Harris and Trump, had probably the biggest differential. We all know that the Tax Cut and Jobs Act of 2017, enacted in the first Trump administration, significantly lowered corporate tax rates, lowered in individual rates across the board. That act is due to sunset in the fall of next year, and the positions of the two candidates couldn't be more different. The Trump administration was promising to keep corporate tax rates at 21%. The Harris administration, or the Harris campaign, was promising to raise corporate taxes to 28%. On the individual side, and that does play into businesses as well, because the majority of businesses are what we refer to as pass-throughs. They don't necessarily pay, they pay at individual rates, so it gets passed through to the owner. And so the individual rates matter, even though it might be a business. Those rates were cut pretty substantially, and were, again, due to the sunset. And the Trump administration is promising to at least extend those cuts, and in many ways, a whole host smorgasbord of other ways that they may cut taxes. Whereas on the Democratic side, the Harris campaign was talking about letting those rates sunset, so you'd have significant increase in individual tax rates. There were talks about wealth taxes, which I never bought into. I think it's impossible to administer, but there was a big difference on the tax front. And I think there's kind of a collective sigh of relief that we're not going to get some of those adverse tax policies that may have come down the pike with a Harris administration. Plenty of arguments to raise taxes, obviously, and we'll talk a little bit about our debt and deficits in a little bit. But nonetheless, I think there was a sigh of relief on the tax front. On regulation and reform, I don't know that I'm being partisan to say that the Biden administration was pretty heavy-handed when it came to regulation, whether it was on the environment, whether it was on mergers and acquisitions with the DOJ's, Department of Justice trade attorneys, Jonathan Cantor, Lena Khan at the Federal Trade Commission. So you can think of all these mergers and acquisitions that were denied for a variety of legal reasons by the Biden administration. So one that was in the news recently was Albertsons and Kroger in the supermarket industry, JetBlue and Spirit Airlines in the airline industry. There's plenty of examples in the technology space where mergers were prohibited. So it is generally viewed that the Trump administration, or Trump 2.0 as I'm calling it, is going to be easing regulation in a material way. And then on the reform side, I believe this is getting more hype than what it will likely end up with. But Elon Musk and Vivek Ramaswamy doing the DOGE, the Department of Government Efficiency, which seems to me an oxymoron, but nonetheless, there's a lot of hype about that. I don't think it's going to materialize because, as I'll show you in a few minutes, the majority of the government spending is in entitlements, and President Trump's and both candidates argued not to do it. So I think regulation and taxes is what kind of fueled animal spirits, that certainty on taxes and an easier regulatory environment was perceived to be pro-growth. The wild card to me is tariffs. Very active debate on tariffs as to whether they are being used as a negotiating tool or are they absolute. So, the narrative on tariffs is that tariffs are bad. And every economic textbook will say that, but most people truncate the line where tariffs are bad when operating in a free and fair market. I don't know that China or Mexico or even our friends in Canada and Europe play fair. And so I think it remains to be seen whether we'll get the full impact of the tariffs as advertised. And if that's the case, that would be more than likely inflationary and viewed as a negative, or whether this is just being used as a cudgel or a hammer in negotiations, and will achieve a little bit fairer trade positions and perhaps better job prospects for the United States economy, that remains to be seen. But I think the impact of the election, I think these are the three major places, and for the most part, they're viewed as pro-growth. I think most of the people are kind of holding their breath and hoping that the tariffs are in fact a negotiating tool and not going to come to full fruition. That all remains to be seen. But clearly the equity markets have liked the results of the election, kind of lower taxes, less regulation, more efficient government, all leading to kind of revival of animal spirits, as they say. On the regulation front, for those of you who are Mel Brooks fans, History of the World Part 3, this is Mel acting as Moses coming down from the mountaintop with the 15 commandments, and he drops the stone and then declares it's 10 commandments. But it just gives you a sense of the regulatory environment. And certainly as somebody who works in a bank, banking is a very heavily regulated environment. And I know many of you work in banks, so we get that. But the joke here is that the 10 commandments kind of ruled the world for millenniums. And, it was just 10 lines. And when you look at the Federal Register, we have over 100,000 pages of regulations. I heard President Trump today talking about how in his first administration, for every one regulation, you had to remove 2. Today, he suggested they were going to try to remove 10 for every one. Will remain to be seen. But, tariffs, taxes, and regulation, I think, summarize what we're doing on that front. I believed and stated in presentations that whoever won the election was going to have their hands full for a number of reasons, all of which I think have inflationary tendencies. The first is U.S. fiscal policy, which I believe is a mess. For those of you who have heard me speak over the years at the EPIC events in the summer, this is something that I've railed on for a while. And I find it amazing now that President Trump's elected, people are shocked that we have to cut spending and get our act together. But when you look at government spending going back many years, it's kind of exponential. That has led to a pretty significant increase in debt levels that, while I do not think it's a clear and present danger to the U.S. economy, when you start to look at those gray bars forecasted out, it does become problematic. The reason why it's becoming problematic is interest rates are normalizing. And when you look back to 2007, in 2008, when we had the financial crisis, we have effectively had close to 0% interest rates. So increasing the debt really didn't cost politicians much. Now that rates are increasing, debt servicing, the net interest expense is increasing pretty meaningfully, and it's starting to crowd out some of the economic activity that we would prefer to see. I noted, I referred earlier to the DOGE and the expectations that they're going to cut out all of this spending. So Elon Musk talks about cutting out $2 trillion. He doesn't really give a time frame. But $2 trillion on an outlay of $6 trillion is a pretty big number. At the same time, President-elect Trump has talked about not touching Social Security, Medicare, or any of the mandatory entitlement programs. And you can see from this chart that basically 60% of our federal budget is entitlements. And if you're not going to touch those, and then if you go kind of towards 11 o'clock and 10 o'clock, net interest, you have to pay those. So I don't view that as discretionary. And given the turmoil in the world, I don't know that defense is all that discretionary. When you add that to it, 70% of our budget is kind of on autopilot, which leaves non-discretionary defense at 15% to cut. So I think perhaps the expectations for government efficiency may be overstated, at least if you're saying the entitlement programs are hands off. How does this manifest itself? It manifests itself in the marketplace through increases in government debt issuance. So you can see here quarterly Treasury refunding. You can see the dollar amounts are now pretty comparable to what they were during the COVID crisis. and you can see that they're starting to sustain at a high level. Higher debt issuance generally leads to higher interest rates. Higher interest rates become very expensive, and it's one of the reasons why I'm a little sanguine about being overly optimistic on interest rates. Secondly, we'll talk about our buddy Hal and artificial intelligence. Listening to a Jimmy Buffett song. I don't know if you're familiar with fruitcakes, but in there he talks about Stanley Kubrick, who was the creator of Space Odyssey, and Hal the computer. But Stanley Kubrick and his buddy Hal don't look that abstract anymore. Why do we talk about artificial intelligence? Because the demand for energy and the stress that it's going to put on our electricity grid is really, really remarkable. And it comes at a period of time where commodity development, whether it's copper mines or uranium mines, cobalt mines, lithium mines, it's really difficult to start mining these things. We already have what is estimated to be peak copper production this year. Yet if you look at the chart on the left, we need to replace close to 50 million miles of copper lines to get our electric grid in order. And when you decide to stick a shovel in the ground for the typical copper mine, it's at least 10 years before you get copper out of it. So I'm a little concerned that this demand and the stress on the electric grid and in a commodity world that's not prepared for it is really troublesome. You can see that being problematic in places like Germany, where you're having political turmoil because energy prices are at record high levels. And even here in the United States, just recently, about 2 months ago, September 20th, Microsoft and Constellation Energy agreed to open up the Crane Clean Energy Center. You may know this as its previous name, which is 3 Mile Island, which was the site of the most serious nuclear power accident. But there is a big push to go into nuclear energy because artificial intelligence and technology, and I would throw in electric vehicles, and I would throw in cryptocurrency mining. The demand for energy is just off the charts, and our ability to provide it is deeply in question. And so we're really starting to scramble around to find out where this energy is going to come from. And I don't know that there's an easy answer, and I worry that that's inflationary. So that, I think, puts the Fed in a difficult situation. We talk about the Fed in one of their last meetings. They talked about how they were recalibrating their policy. So what we do see coming out of the COVID crisis, we had that spike in inflation that we showed you earlier, and then we had that very dramatic increase in interest rates. That is by far and away the fastest rate hike in the history of man. We then had this long pause, and now we're in the expectations tomorrow for another 25 basis point rate cut. So the Fed has begun to cut interest rates. I am a little concerned that this inflationary pressures from large debt and supply chain constraints when it comes to electric grids and energy inflation is not behaving as well as it was a year ago. And so the Fed is talking about searching for N-star, which is the neutral rate, the rate that is neither stimulating nor restricting the economy. The Fed believes it's restricting the economy right now with rates that are too high, and therefore they're widely expected to cut rates again tomorrow. However, I think what's happening is N-star is rising. When you look a year ago, the expectations were for Fed funds to settle back into the twos. 2.9% is the current target for the Fed if you look at their dot plots. I think what's happening is because economic growth has been more resilient, the labor markets have been pretty solid, and inflation, while it's trending lower, seems to be stabilizing at 3% rather than the Fed's 2%. And I think the market is grappling with what to expect from interest rate cuts. And my belief is this N-star is starting to rise and is probably in the high threes, maybe even 4% as opposed to the expectations for rates to go back down into the twos. And I would add, this would be careful what you ask for. When we were in the twos and when we had 0% interest rates, it was because we had a financial crisis in 08, 09, and we had a horrible global pandemic in 21 and 22. I'm not sure I want to go back there to get really low interest rates. And when I look at the fixed income markets, credit spreads, if you in fact thought that we were going to go into this inflationary spiral or we were going to go into this recessionary world, you would think credit spreads would be a pretty good determinant of that fear. And if you look at the middle of the chart, when you see the spikes, the maroon line is investment grade and the blue line is high yield. And you can see in the financial crisis how credit spreads just totally exploded. That is fear of an economic slowdown, an economic recession. If you look today, credit spreads are as tight as they ever been. So when I listen to the Fed saying they're restrictive, that is not an indication of a market that's running wild. And so what we have is an interest rate environment that when you look at the blue line pre-COVID, that is what I refer to as a normal yield curve, positively sloped. Really good news for banks. Banks like to, we borrow deposits in the short end and we lend out, and autos in 2 or 3 years, and commercial loans in 5 to 10 years, and mortgages in 30 years. So we like that positively sloped curve. You see where we were in the middle of 2023 with the gray line with a sharply inverted yield curve. And then you can see where we are today, where the yield curve is largely flattened. And on the longer end of the curve is measured by the differential between the 10-year Treasury and the 2-year Treasury. We're now positively sloped by 15 basis points. The expectation was for the short end of the curve to come down as the Fed cuts 6 or 7 more times. I think the Fed will come out tomorrow and cut rates and use language that says, yeah, we needed to cut rates a little bit, but economy's been resilient, labor market's holding up, inflation's being stubborn around 3. We might pause, and you can see it in the market action where the expectations for interest rates to go down in 2025 are being modified pretty quickly over the last few months. And I do think this chart is really powerful. It really gives you the yield of the 10-year Treasury in blue. So right now that rate is roughly 440. And then over time, it goes back to 1958 and backs out inflation. So the nominal rate, the blue line, minus inflation, gives you the red line, which is real interest rates. When you look at that real interest rate, it's 193 over that 60, 70-year period average. And so let's give the Fed the benefit of the doubt and say it gets to its inflation target of 2%. If I have a 2% inflation rate and real yields are 200 basis points over inflation, that tells me the 10-year note should be trading at around 4%. It's currently 440, and it was 420 5 days ago. So I just think people need to manage their expectations for interest rates. And when it comes to the equity markets, that is a big factor. So first of all, operating earnings that you can see here, the good news is corporate earnings have been incredible. They've remained very strong, and you can see their forecast to grow at nearly 14% next year. I look at that and say artificial intelligence is driving some wild expectations for earnings increase. I worry a little bit about the expense being certain. So Google, for example, has announced they're going to increase artificial intelligence spending from $4 billion a year to $5 billion. And then when they're asked, when are you going to get a return on investment? They basically say, we're not sure. Maybe 3 years, maybe 5, maybe 10. Well, when I'm paying really high PEs for that uncertain earnings stream, that doesn't last very long. And this chart gives you the average PE, the standard deviation above, standard deviation below. And you can see when the market trades above one standard deviation of historic PEs, where it is today. And the other time it happened was in the dot-com bubble, most recent time. I can tell you that bad things happen, and at a minimum, expected forward returns should be dialed down because the market just doesn't have room for explosive growth like it has in the last 2 years coming out of COVID. And so that doesn't mean the market's going down. It doesn't mean interest rates can't go lower. I just think we need to temper our expectations. So summarizing this all up, economic growth has been resilient. It's running above trend and may slow down, but it's probably going to slow down to its long-term potential at 2%. The labor market has been slowing, but it's still, a pretty pristine number at 4.1, 4.2. Inflation has been trending lower, but the last 4 or 5 months, it's kind of flatlined. I think that's a concern for the Fed. We talked about the strength of the consumer, and I would add corporate balance sheets are very strong, and I think that gives us a little bit of protection against a deep, dark recession and or bear market. The Fed has cut rates the last 2 meetings, widely expected to cut rates tomorrow, but I think they're searching for that end star, and I think you'll hear language tomorrow that basically says, well, maybe end star is a little bit higher than we've been projecting. So you might see discussions about end star going from 2.9, which is the current dot plot. It wouldn't surprise me to see the end star going up to 3.5 or something like that. So again, manage your expectations for declining rates. I think the new Trump administration, the wild cards are those buckets I talked about: tariffs, taxes, and regulation. I think taxes and regulation and reform are clearly growth oriented. The tariffs, we have to see what they actually look like before we can comment, but have to acknowledge that if they go do the full Monty of 60% taxes on tariffs, would more than likely be inflationary and problematic for the economy. And then lastly, for equity market values, they're stretched. It doesn't mean the market's going to drop tomorrow, but I think the likelihood that you're going to get a 20% return again is going to be difficult. The market still remains remarkably concentrated in technology stocks, which historically is not a good thing. And so when you look at the equity markets, you better get that, if my forecast here is right, you better get that rapid earnings growth, because I don't think you're going to get as much help from interest rates lower. So with that, I'm going to stop there. Joe, I don't know if there's questions, but I'd be happy to take questions. I'll be here all night.
Well, thank you very much, Ken, and we will open the floor for a few minutes of questions. So if you do have something that you would like to run by us, please enter it into the question panel now. I've got a couple, Ken, that I pulled aside before we started. So let's start with, obviously we're in the throes of the holiday season, and shopping this time of the year does a lot of good for our retail sector. Do you have any early indication on how it's going and how it's going to impact the economy?
Yeah, it's in fact, I was just listening to a retail analyst about a half hour ago, and the consumer continues to spend, and I think it gets back to that chart where the wealth effect of rising home prices and a strong labor market where wages are starting to catch up, and financial wealth from every asset class going up in value. The consumer has proven to be very resilient. It's interesting. The consumer has been, for really the last year and a half, as a do as I do, not as I say. The consumer has been very cautious. Ooh, I'm worried there's going to be a recession. There's the debt levels are high, the political turmoil we have, geopolitical risk, all these things which are all perfectly legitimate concerns. Yet when you look at what they actually do, they're spending like crazy. Planes are filled, hotels are filled, restaurants are filled, and it does appear that the forecast for 3% plus growth for the holiday sales season looks like it's going to be achieved. So, short answer to your question, Joe, looks like the holiday spending is going to be pretty solid.
Great. One other question that I had, obviously in preparation for our session today, as we know, there's quite a unique relationship between President-elect Trump and Fed Chairman Jerome Powell. How do you think that will impact, obviously, what the Fed will do into 2025? And obviously, there's been questions about whether President-elect Trump can remove the Fed Chairman from his position. And but if you could give any thoughts about that as well.
Yeah, so I think there's a lot of bluster going on, mainly from President Trump, but I think it's more bluster than it is reality for a couple of reasons. One, Chair Powell's term ends in 2026, and so that's a year away. So I don't think, I don't think Trump's going to act imminently. There's a big legal debate as to whether the president has the ability to replace the Fed. The Fed chair, the Federal Reserve Bank is a creature of Congress. It's not really part of the executive branch. So there's a question whether you could legally do it or not. And so I think there really needs to be a compelling reason for Trump to do that. To be fair to President Trump, most presidents want lower interest rates, and so the idea was that the Fed kept rates too high for too long, and it slowed the economy, and that was the source of Trump's angst. The reason why I think it's also so, one is the legalese of it is challenged. Secondly, and I think much more important, the Fed's in the middle of cutting interest rates right now, and hopefully, as my presentation has demonstrated, I think the likelihood, I think rates will not go as low as what was anticipated, but I think the likelihood that the Fed is going to be forced to raise rates over the course of the next 6 to 9 months is pretty small at this point. So I don't know that there's a compelling reason for Trump to throw Powell out in the first place, because Powell's already cutting interest rates, and that's what Trump presumably wants. And when we do get to the point when it's time to raise rates, and again, I don't think that's in the foreseeable future, it's going to be nearing the end of Powell's term. And again, politically, could Powell say he wants to return for another term? Maybe, but he's of the age and certainly has been a very successful private equity investor. So I don't think he's doing this for the money. My guess is Powell just plays out his term and rides off into the sunset. So unless something really dramatic happens, I'm going to put the Trump versus Powell fight into the bluster category, with the probability of it really becoming having a material impact on the markets. I would assess it being pretty low.
Right. We did get one more question in through the question panel. Any insight on foreign markets going into 2025?
Yeah, so the foreign markets are pretty interesting. And I would say all markets outside of large cap US are really, really interesting. But it takes a pretty bold or strong heart to do it. So whether you're comparing small cap and mid cap stocks here in the United States to their large cap brethren, or you're looking at Europe or Asia, international writ large, every equity asset class other than large cap equity trades at much, much more compelling valuations, PE ratios, price to sales, price to book, whatever metric you want. They are far cheaper than the US market. Now, the US market doesn't look like any of the other markets, particularly when we compare ourselves to the other developed countries. So that would be Canada, US, Canada, Europe, Australia, Japan, in that when you look at the weighting of technology, and I do include technology and consumer services in one bucket here, the US market's 40% technology or tech related. When you go to Europe, technology is single digit weightings. When you go to Japan, it's single digit weighting. So the rest of the world, if you want to look at it, the US is pretty much a new economy basket of stocks driven and dramatically weighted in technology. When you look at our international competitors, I would describe them as old economy stocks. It's finance, it's industrials, it's manufacturing companies, things like that, automobiles, things like that. So if you think of take Germany as an example, they're legendary for their manufacturing prowess, but that's a really tiny part of the overall world economic scene, and all the juice is going in technology. So it stands to reason that German stocks should trade at a lower PE versus the high-flying U.S. Tech sector. That being said, valuations matter, and reversion to the mean is one of the most powerful forces in the universe. The question is, how cute do you want to play it? So I would say international stocks, or really any other equity asset class other than large cap growth, are materially cheaper, which historically means the longer term results will be better if you diversify away. But there's, like I said, there's good reason why the tech sector is so highly valued, because that's where the growth has been. So a difficult kind of a personal or a decision to be made whether valuations are so compelling or not. But clearly, large cap growth has blown away every other asset class in the equity space for really the last 2 years.
Great. And that looks like that wraps up our questions for today. So we would like to thank Ken and thank all of you for joining us for this Epic Insight webinar. As a reminder, we will be sending out a copy of today's presentation as a follow-up. As always, please do not hesitate to contact us if there's anything that Epic Retirement Plan Services can do to support you and your efforts. And lastly, we'd like to take this opportunity to wish you and your families a happy and healthy holiday season from Epic Retirement Plan Services and MBT Bank. We thank you, and we look forward to seeing you again on our next edition of Epic Insight.